Hi, this is Ben Poole for Finextra, and I'm joined by Steve Pulley from Thomson Reuters. Steve, thanks for joining me. So over the past year, what are the key themes that you've seen emerging around the biggest problems with KYC onboarding?
Yeah, we've seen a number of key themes here. I'd say regulation and compliance is probably number one, and the burden that that's creating for our clients, both on the buy side and the sell side. A good way of looking at it is just the number of regulatory alerts that are coming out every year, which has grown by a factor of 5 over the last 7 years, and it's really driving up the burden of demand on the compliance function within these organisations. They're having to recruit heavily, and whilst there are opportunities to automate, it's driving up the cost base. So actually, in turn, really cost is the biggest issue overall. The banks are looking to get back to acceptable levels of return on equity. They need to be growing the business and attracting new customers, which means good client experience, but at the same time, finding ways to reduce costs, not grow them in this time of increasing regulation. And I think that's where these industry utility concepts, where there's opportunities to mutualize cost and share it across a number of institutions who are all doing similar sorts of activities, are really kind of coming to the forefront right now.
And one consistent piece of feedback has been around how time-consuming and disconnected the whole experience has become for the client. Is the client becoming lost in client onboarding?
I think so. When you imagine yourself as a client, and potentially a large client, whether that's a corporate, an asset manager, or a hedge fund, where you've got multiple banking relationships, you're being touched by each of these firms every 1, 2, or 3 years, depending on your risk profile, to provide KYC information. And each of the firms have similar but not the same compliance policies. So you're there scratching your head wondering why they're asking you for slightly different pieces of information. And they're coming at you asynchronously. They're coming at different times and multiple times a year, which, if you're a $10 billion listed company, you probably haven't got a large company secretarial function. That's a big burden that's being placed from an administrative perspective. So we see that as a real challenge for our clients. We probably also see the time to open an account as being a major challenge as well. And so much focus on tick box exercises around information collection that are now taking certainly new hedge funds between 75 and 150 days to get through the exercise with their banks just to be able to open an account. People investing in hedge funds expect their managers to be in the market with their money, not sat in cash on the sidelines for that period of time. So yes, it's a pretty challenging time for the customer.
And obviously we've seen a number of banks fined considerably. What impact is this having on the buy-side community?
Yeah, it's quite interesting. The buy-side, and particularly the large money managers, the folks with $1 trillion worth of assets under management or more, what we're seeing is, and it's quite widely reported in the press, is this movement towards attempting to classify them as SIFIs, globally systemic financial institutions, which, a la the banking sector, will bring with it a whole range of challenges, both in terms of increased regulation, potential capital controls, or requirements that don't perhaps exist today, which could distort the competitive landscape. We think, and we see evidence, that increasing regulation is going to drift over from sell side to the buy side as the buy side becomes the new sell side. We're seeing more and more liquidity and capital flows to the buy side. We're seeing more and more hedge funds and asset managers taking on traditional core banking activities, and therefore one would expect that regulation to transfer across and thus feel similar sorts of challenges.